Welcome to episode 4 of Equity Shares. Today, we're going to discuss how to secure a business loan. Most entrepreneurs always ask three the top questions that I receive, especially in my profession, is how do I become bankable? So, rule number one, most lenders are going to want to know that you have been in business at least 2 years. So, having 2 years of financial statements to support any of your borrowing needs is going to be extremely important as you approach any lender or bank for financing. The other thing that you want to think about when you approach that lender is, does the purpose of my request match what I'm asking for? So you want to make sure that if you're asking for a short-term loan, like let's say a line of credit, that is something that you believe can be repaid within 12 months. If you want a long-term loan, then you need to request something that's going to be longer than 12 months with a fixed payment, fixed rate, so that way you can get the best bang for your buck. The other key thing that lenders are going to ask, and they're going to want to know is, one, do you have the cash flow, the excess cash flow after you pay off your expenses? Do you have enough profit to take on more debt? So you want to make sure that your business is profitable when you come to the bank and you apply for additional credit. And then if it is profitable, is it enough cash flow with a cushion to allow you to pay off any new debt that you add on? The other part is, do you have collateral? So what are you using to secure it? What's going to be the second source of repayment if somewhere in your business you have a change in your cash flow and something, maybe sales are not as high as they used to be. There's some type of event that has happened economically that has impacted your business. What is the second source of payment if your cash flow declines? And the last is, do you have a third source of repayment? Are you going to personally guarantee, meaning that you'll sign to say, if the business cannot repay the debt, then you'll use your personal assets to repay the debt? Or do you have another source of income that can support the repayment of the debt if the collateral and the cash flow just isn't enough to support the repayment? The other the top two requests is, who should you have on your team? So 3 advisors that most people, that I recommend most people to have is a banker, a CPA, as well as an attorney. And these should be advisors. These are not transactional individual relationships. These should be people that have your back, that are advocates for you, that are giving you ideas, sharing information, being a resource for you. People that have industry experience, so they understand your industry and how to work with clients in your industry. And sometimes it's worth it to pay that advisor the value that they bring to your business, especially if they're saving you money, saving you time, and adding value to what you do so you can be successful. So a banker, a CPA, and an attorney. The third most asked question that I receive a lot is, what is the big difference between my building my personal credit and also building my business credit? And what I'll say to that question is, your personal credit is always, especially for a new company, is always going to stand out and be highly valuable when you go and apply for a loan for the first time, second time, or typically for small businesses, anytime you apply, you're going to want to make sure your personal credit is in the best possible shape it can be. So personal credit ranges, your FICO score ranges from about 350 to 850. There are three credit bureaus that can pull your FICO score, and that's Experian, Equifax, and TransUnion. And the key thing that you're going to want to look for is, do you have, any past due payments? Is there anything on your credit report? Do you have high revolving balances? So if you have credit cards, if you have lines of credit, are you maxing those out, or is it low balances, things that you're paying off every month? And then also the score makes a difference. So are you 650 and above, or are you 650 and below? And then why are you 650 and below? and making sure that you have an understanding of where you are and why you're there and what you need to clean up is extremely important. So before you go to borrow money for yourself or your business, I would always recommend pulling a credit report to make sure that everything on there looks accurate. And there are a lot of websites that you can utilize to get a copy of a free credit report so you don't have to pay for it. As it relates to business credit, typically business credit, there are three sources that lenders will look at to kind of see how your business has been managing debt. And that's Dun & Bradstreet, as well as, and what they're looking for is they're looking for judgments, looking for lawsuits, anything that would show that you have not been paying your vendors on time. And so if you don't have a business credit, then they're highly going to depend on your personal credit to show how you're going to pay that debt back. And so it's extremely important to make sure that, like I said, your personal credit is in order, because if I'm a lender and you're looking to borrow money from me, I'm looking at you as if you're going to be my primary source of repayment, despite the fact that you have a business, because the individual is the one that'll have to pay the debt. So making sure that, once you have a business, that you keep your payments on time to those vendors is extremely important. And typically when you're first starting out, the only things that'll be available to you in less than 2 years are credit cards or trade lines with vendors that where they're extending you credit because of your relationship and payment history with them. So depending on what your business is, there are ways, even if your personal credit is not the greatest, to get access to some form of financing. But just keep in mind the less risk that you take and the more risk that somebody else takes, it will cost you. So keep that in mind, that usually you're going to have to borrow at a higher rate if they are taking more risk lending to you at that point in time. So the other thing I wanted to talk about too was just making sure that revolving debt and make sure you have a full understanding of what revolving debt should be used for and what term debt is used for. And so revolving debt, again, is debt that you borrow that consistently can go up and down. You have a limit similar to a credit card or a line of credit. That debt is meant for short-term use. So things that you can pay off in full in less than 10 months, in less than 12 months. And so if you are a business and you're looking to use a line of credit for emergencies or for buying equipment, let's say fax machines, copiers, furniture, that purpose doesn't quite match what a line of credit should be used for. And ideally, you want to make sure you have that understanding in mind before you go to a lender or a bank, because that's going to come up in how you're going to utilize that facility. And if you're using it for something, let's say you're using it because you have an invoice, you invoice a person and they're supposed to pay you in a specified period of time, let's say 30 days or 45 days. Once that invoice is paid in that 30 to 45 days, the expectation is that you'll clear the balance on your line. So that's the proper use of what you should use revolving debt for. Term debt is for a specified term, typically longer than 12 months. So equipment, vehicles, buildings, that's what term debt, that's what the purpose of term debt is going to be for. And that's how you can make sure you match that purpose with the usage of those funds. The last thing I wanted to mention too was business debt does not show on your personal credit report. And so again, that's where we go back to Dun & Bradstreet and the judgments and the lawsuits to make sure you're paying what you have owed to vendors, that you're paying it on time. And so a benefit in a lot of cases to individual owners is that anything you have on your business side will not show up on your personal side when you go and apply for a mortgage. And so that's key, because not a lot of business owners understand or know that, especially the ones that are just getting started. But make sure, again, 3 things to remember. Make sure you're at least 2 years in business prior to applying for a loan, a business loan from a bank or a lender, unless it's an SBA loan, which there are some benefits there. And so SBA loans will allow you to apply even if you're not, you haven't been in business for 2 years. 2, make sure you have those 3 advisors, a banker, a CPA, and an attorney in your corner to protect you from risk, and also to give you ideas, share resources, and one that has expertise in that industry. So they know your industry, they know how you operate, and they can be of value to what you do. And the last one, again, understanding personal versus business credit. I think it's a myth that if you have terrible personal credit, then that will put you in a position to get all the business credit that you need. That's not specifically the case, but you can get access to trade lines, and you can get access to credit, usually at a higher rate as you're just getting started. But my recommendation is to make improvements to your personal credit so you can get the best possible terms rate that are out there to the best possible clients. So this is episode 4, again, of Equity Shares, about let's talk business, how to get your business bankable, and how to get funding and find sources for your business. Thank you again, and have a great day. And hopefully you saw some value in this time. Take care.
Thank you for watching The Equity Partner. My name is Jeff Marshall. Please subscribe to our YouTube channel. Please like the video and share it. And we look forward to bringing you guys more content. Take care.